Hello and welcome to the Global View on this Wednesday. I'm Andrew Geoghegan. Thanks for joining us again here at Ausbiz. Let's get across those developments from overnight. Israeli and US forces continuing to strike targets across Iran, while Iran has launched retaliatory strikes on Gulf states. Equity markets have plunged and energy prices have soared, prompting concerns about inflation. Wall Street's main indices tumbled at the opening before recovering to some degree there, but the S&P still hit its lowest level in more than 2 months, with the market worried that the US is being pulled deeper into the conflict than investors had expected. The small caps Russell 2000 index also sliding, and Wall Street's fear gauge, the Cboe Volatility index, spiking to a fresh 3-month high. Well, tech stocks fell, led by losses in Nvidia. Airline and travel stocks were sold off for a second day, with flight chaos continuing around the Middle East. And US listed shares of gold miners fell heavily as the bullion price buckled under the weight of a strengthening US dollar. Another concern for investors are the cracks emerging in the private credit market after Blackstone's flagship credit fund, BCRED, saw a surge in redemption requests, which dragged other listed fund managers lower. Retailer Target surged after its new chief executive pledged to return to sales growth and issued an upbeat profit forecast. And Paramount Skydance fell heavily after Fitch downgraded the company's rating to a junk following its recent proposed acquisition of Warner Brothers Discovery. And the Pan-European Stock 600 index lost more than 3%. The banking index at a 3-month low, with UK lenders seen as more exposed to Middle East risk, taking the hardest hits, among them HSBC. Well, 4 days into the war in the Gulf, President Trump has said that the US military had struck numerous Iranian naval and air targets, saying that just about everything had been knocked out. This as the conflict spread to Lebanon, with Israel targeting Hezbollah. Iran has fired missiles and drones at neighbouring Arab states that host US bases and strangled shipping through the Strait of Hormuz, where a fifth of the world's supplies of oil and liquefied natural gas transit. Investors are dumping bonds globally on fears that the US-Israeli war on Iran will stoke inflation. Fed member John Williams has said that so far the impact of the Middle East war on markets was reasonably muted, in particular rising energy prices, saying the important question is quantitatively how big of effect this will have on the US and how persistent those effects are in terms of price stability. While fellow Fed member Neil Kashkari has said now with the geopolitical events we need to get a lot more data. Right now it's just too soon to know what impact this has on inflation and for how long. Well, US Treasuries have slumped for a second day as surging oil prices prompt traders to dramatically reassess the prospects of more interest rate cuts. The US 2-year Treasury yield rising to 3.51%, the 10-year was around 4.06%. Australian 3-year government bond yields rising to 4.36%, the 10 at 4.79%. And the US dollar index was up around 1% on the day, the Aussie slipping to 70.4 US cents. President Trump has said if necessary, the US Navy will begin escorting tankers through the Strait of Hormuz. And Qatar, which is among the world's biggest liquefied natural gas exporters, has halted its LNG production. Oil prices have surged further, disrupting global energy shipments due to what's going on in the Strait of Hormuz. Brent is up 12% since the conflict began on Saturday at $85 a barrel. And gold has been weighed by stronger US dollar and dimming prospects of rate cuts on rising inflation concerns. Spot gold was down about 4%, currently trading at around $5,100 an ounce. Copper fell more than 2%, iron ore up slightly, 103 US a ton, and Bitcoin is back to around $68,000. Well, joining us now is Anu Ganti, is the head of US Index Investment at S&P Dow Jones Indices. Anu, great to have you back on the show. Can I first get your reaction to what you've seen on markets, in particular with the S&P, as I mentioned there? It was a difficult day on the market today, your time.
It certainly has been a roller coaster over the past couple of days. We're down and up, and then we were down again today. So volatility is the name of the day, and we're watching volatility very closely, specifically implied volatility in the VIX above 20. Another measure that we're closely watching is we have an index called DSPX, which is a measure of implied dispersion. So there's a lot going on under the hood. You called out a couple of points, specifically oil. We are looking very closely at the energy sector, which of course has been outperforming. But if you look under the hood at the specific industries, very different movements. For example, we've seen outperformance over the past day within oil and gas exploration, outperforming our oil and gas equipment index, for example. So important to understand the sectoral drivers and industry drivers in terms of performance. Now, coming back to volatility, the tech sector is another trend that we're watching with the dichotomy and the divergence between software stocks versus chip makers. And you mentioned NVIDIA's fall earlier. That is another trend that will be important to watch as well, is looking at market sentiment from a volatility perspective. And specifically, we're seeing that greater idiosyncratic risk, particularly within energy and technology, for example.
Well, Anu, this comes at a time where I see that you've actually released your scorecard report. This is the S&P Indices Versus Active, the SPIVA US year-end report. And interesting that those large cap domestic equity funds there in the US have underperformed the S&P 500.
It certainly is interesting, and it's very timely in terms of historical lessons that we can learn. For example, what you're showing here is that 79% of large cap managers underperformed the S&P 500 in 2025. And with the current environment and tumult that we're seeing, it's very reminiscent to last year, and specifically early April of last year, when there were similar geopolitical tensions going on. Now, we produced this report twice a year. In the first half of the year, we actually saw that only 54% of large cap managers underperformed the S&P 500. Relatively better results. There was greater dispersion. Now, coming to the latter half of the year, things got tougher. We, of course, saw the recovery in technology and mega caps, which may have been a headwind. So it was certainly an interesting year, another tough year for active managers. And frequently, we hear that this is the time to shine in terms of greater volatility, market downturns, and we'll be watching to see that in the coming months. But of course, I think 2025 was an important lesson that it's really tough to beat the benchmark.
Now, Anu, of course, recent events aside, AI has dominated over the past year or so, in particular at the beginning of this year. But of course, you're focused on 2025. We did have seen that sell-off over the past couple of months, particularly in tech and the software-related companies, on fears of AI disruption. What have you seen there, I guess, when you rate the overall performance on those comparison indices? In fact, we're going to bring up the chart.
Yes, no, it's an excellent question. It's certainly infiltrating a lot of our indices. What you're looking at here is the benchmark performance across our SPIVA categories. 2025 was a very unusual year because, for example, we did see that large caps, S&P 500, outperformed small caps, but international actually did better than the U.S., which had important implications for international managers, particularly international small cap managers, with 70% of them underperforming. You see that the S&P Developed X U.S. Small Cap Index was up 35%. So that was a really high hurdle to beat for international managers. I will say that a bright spot was in emerging market equity funds. They did relatively better. Perhaps the weaker dollar was a tailwind. EM debt funds did relatively better. So there were pockets of opportunity.
And you mentioned there earlier, just in terms of dispersion, what did you see there, I guess, particularly for those stock pickers in large caps?
Excellent question. We're looking at dispersion closely. And in our February report, we actually saw that the story was really in mid and small caps. For example, if you look at S&P mid cap 400 dispersion, it hit roughly above 50% annualized in February, the third highest monthly reading going back to 2007, which was pretty interesting to see. So more idiosyncratic risk within the mid and small cap space. that also coincides with the rotation that we've been seeing towards smaller cap stocks. And it'll be interesting right now with the geopolitical tensions that we're seeing, the macro changes going on, to see if that'll be a potential tailwind for the smaller, more domestically sensitive stocks.
Well, interesting you say that because, in fact, we're going to go to the next chart. Just in terms of that mega cap dominance, we have seen that rotation into the small caps. Interesting to see how this played out over 2025.
It really was interesting to see that you look at this chart right here, and it really says it all in terms of 78% of the contribution of the top five stocks in Q1 when the market was declining, steadily declining throughout Q4 to 11%. So for active managers who were underweight the largest stocks, this may have been a tailwind. But of course, it wasn't a full panacea. For example, if you look at our equal weight index, which is a measure of just how the average stock is doing, we saw that it outperformed in Q1, but it actually underperformed through the rest of the year. We did see that rotation, the broadening of the rally throughout the end of the year, but it may have been a case of just too little too late and still difficult circumstances in 2025.
Well, it's going to be fascinating to see how 2026 plays out, given there's been so much at play just in the first 2 months. Anu, great to get across what you've seen there in terms of your scorecard from S&P for 2025. Thanks for joining us.
Thank you so much.
Anu Ganti, Head of US Index Investment at S&P Dow Jones Indices. Let's return to the local market then. Yeah, that tells the story, doesn't it? We are expecting heavy losses when we get going in just a couple of minutes' time, reflecting on what we saw on global markets. That was particularly pronounced in Europe. Some of those bourses there down around 3 or 4% as the conflict now entering its fifth day in the Middle East. We'll get across all of that and the analysis in just a moment. Stay with us for the open.